The last repo volume that we saw was 2947, 2.947 trillion, and reserves are now just below 3.2 trillion. So if we take away what was this average number, it was $143 billion. So if we take $143 billion away from 3.2 or 3.15 trillion it is now, then we're going to hit $3 trillion. While this number keeps rising, they're going to get close enough that they're probably going to cause some kind of repo crunch. And then the question is, what happens then? I don't think it's going to lead to an immediate crash of everything because the Fed is going to step in almost immediately and alleviate it, but it means that the money printing presses are going to restart, and gold and silver are probably going to respond pretty well after maybe a brief sell off once the apocalypse hits.
Rafi Farber is ringing the alarm bells. September could be the month everything breaks. Every year, right around the third week of September, the banking system takes a massive hit as billions are drained out for corporate tax payments and Treasury auctions. That money doesn't stay in the economy. It's yanked out of commercial banks and parked in the Treasury's account at the Federal Reserve, completely outside the regular banking system. Over the past 4 years, these September outflows have averaged roughly $143 billion, dragging bank reserves closer and closer to the critical $3 trillion threshold. And according to Farber, that number is no coincidence. It's the danger zone. Once reserves fall too far, the repo market, the overnight cash machine that keeps trillions of dollars flowing, starts to seize up. And if repo demand collides with shrinking reserves, we could see a repeat of the 2019 repocalypse, when repo rates exploded into double digits overnight, forcing the Fed to stop tightening and restart the money printers at full blast. But this time, the stakes are way higher. The U.S. government is running record-shattering deficits, debt is spiraling out of control, and the entire global economy is hooked on easy money. Farber warns that when the crunch comes, the Fed will have no choice but to print even more, and that could spark a short-term panic sell-off in gold and silver before unleashing the biggest rally of this cycle. History backs him up. In 1979, gold plunged over 16% in just 1 month, and then shot to new highs within weeks. Silver barely moved for months, then suddenly went vertical in one of the wildest moves ever recorded. Farber's message is simple. If gold dips or silver goes sideways this fall, don't panic. That could be the moment that sets off the most powerful phase of the entire bull market. Stick around. We've got clips from Rafi's full interview coming up. And before we dive in, make sure you subscribe and hit that bell icon so you're ready when this storm hits.
This is a chart of the bank reserve change week by week. The change in bank reserves, these are the dollars that fund the repo market. So I've highlighted the last four third weeks of September following September 15th. September 15th, 2019, actually September 17th, 2019 was the previous repocalypse when the repo market froze up and QT had to be reversed for QE. Once again, that was 6 years ago, September 17th, 2019. Now, these are the four Septembers: September 22nd, September 21st, September 20, September 18th in the 2021 to 2024, respectively. It shows you the weekly fall in bank reserves at this time. The reason that bank reserves fall during the third week of September after September 15th is that September 15th is a corporate tax day, so the Treasury vacuums a lot of money out of the banking system into its own pocket, into its own bank account at the Fed, which is not part of the banking system. Also, you have auctions, Treasury auctions clearing on September 15th or 16th or one of those days, and that also vacuums money out of the banking system and into the Treasury. So these past 4 years, we've had September 22nd, 2021, a fall of 106 billion, and then the next year a fall of 155 billion, and then 166 billion in 2023, and finally 142 billion or 143 billion on September 18th, 2024. The average of all these numbers is $142.692 billion. And now you'll see the importance of these numbers in a second, but I'll just tell you that bank reserves are now at about 3.15 trillion or something like that. So if you take it down an average 142 billion, you take it down to about $3 trillion. Why is that important? Because this is what causes repocalypse. The blue line is the amount of reserves in the system. The red line is the volume of secured overnight financing of repo trades that happen every night. If this blue line and this red line meet, you get a repocalypse, or if they get close enough, really, because they're not going to meet exactly. But this was the last repocalypse over here, and you can see reserves started to rise over here because they restarted QE after ending QT when repo rates went to 10% over here when the red line got really close to the blue line. So you can see that is happening again. The last repo volume that we saw was 2947, 2.947 trillion, and reserves are now just below 3.2 trillion. So if we take away what was this average number, it was $143 billion. So if we take $143 billion away from 3.2 or 3.15 trillion it is now, then we're going to hit $3 trillion. While this number keeps rising, they're going to get close enough that they're probably going to cause some kind of repo crunch. And then the question is, what happens then? I don't think it's going to lead to an immediate crash of everything because the Fed is going to step in almost immediately and alleviate it, but it means that the money printing presses are going to restart, and gold and silver are probably going to respond pretty well after maybe a brief sell off once the apocalypse hits. Here is the ratio chart that I show often. This is the ratio of reserves to repos every night. September 6, 2019, they were at 84.6%. We are now at 88.8%, above the previous apocalypse level, so it should happen at any time now. Now, if it happens in September, which I think is likely, though, of course, it's not 100%, and I could be totally wrong about everything I'm saying now, because this is really new territory for everybody. No, the monetary system never really dealt with this before, so everyone's just kind of making it up on the fly, including me. You have here the October 1979 sell-off of gold of 16.5%. In October, we hit a high, October 1979. I think it was October 1st, 1979, or October 2nd, the first business day of October, basically. Gold hit what looks to be about $455 and went down to about $380 by the 1st of November. That was a monthly sell-off of about 16.5%. People thought that the gold rally was over, but no, it was not. It was only just beginning. It went from $380 to about $872 in about a month and a half, or about 2 months, actually. This knocked off a lot of people. Don't let this October knock you off. We could see a sell-off if the liquidity crunch is allowed to continue for a little bit, but don't freak out about it. It has happened before. We've had bad months, even in 1979, which was the best year for gold ever. In silver, you could see what happened in the same month, October to November 1979. Silver was more static for a longer period of time. For about 2 months, it didn't move. As gold moved starting in November, silver did not. For 2 months, it traded within about $18.50 to $16, $62.50 in that range, and then from there, it went from about $18.50 to $50 in about a month and a half to 2 months, or whatever that is. So don't be afraid of static silver or a sell-off in gold in October following a apocalypse. I'm not saying it's going to happen, but if it happens, it's completely normal.
Lately, financial markets have refocused on gold and silver as investors try to figure out their place in today's unpredictable economy. But here's what's fascinating. History shows that mining stocks tied to these metals often move on a completely different timeline than the metals themselves. Take 1980 as the perfect example. Gold hit its dramatic peak in January, yet homestake mining, the premier gold stock of the time, didn't start its biggest rally until months later. From May onward, its shares skyrocketed from around $7 to nearly $22, tripling in value well after gold had already topped out. This shows that the mining sector has its own momentum and shouldn't be ignored as part of a smart precious metal strategy. Analysts like Rafi Farber point out that mining stocks have unique drivers: operational improvements, investor sentiment shifts, and built-in leverage in their business models that can send them soaring, sometimes even outpacing the metals themselves. That means even when gold or silver prices pause or pull back, the right mining stocks can still deliver massive returns. The takeaway? Bullion is the foundation of wealth, but mining equities are the fuel that can supercharge a precious metals bull market.
Repo market is also the SOFR market, the secured overnight financing rate market, or the secured overnight financing market. The rate is the rate. This is the market where treasuries are traded for cash. The cash comes from bank reserves, and bank reserves and the SOFR volume, the amount of money trading each night, are about to equal each other, which means that there are not enough dollars to support the repo market, and the repo market supports the basis trade, among other things, where hedge funds sell Treasury futures short and buy the paper and profit off of the difference. And if all of those trades are forced to unwind at the same time, you have a liquidity crunch in stocks. And followed by that, if the repo trades are forced to close, then you have all these hedge funds which are buying treasury paper forced to sell them in order to meet their margin calls. And so you have skyrocketing interest rates and falling stock market, and the Fed is going to have to intervene. The Fed will probably intervene before any of this bad stuff happens, but it means they're going to have to start printing money again and restarting QT, which should be restarted in the next 2 to 3 weeks, and we'll go into the numbers as to why. Then we're going to talk about 1979 gold and silver, specifically the month of October regarding gold, where gold fell 16.5% from top to bottom in that month, and silver was static. It was trading in a range for October and November, which is going to be around the time when the apocalypse happens, which could cause a little bit of a liquidity crunch both in gold and silver. But this is completely normal. Gold and silver went down even right before the 1980 spike, and something surprising happened in the main gold mining stock, Homestake Mining, at that time. And finally, we're going to go into something I almost never talk about on these reports, and that is another end game sign that we are approaching the final play or the final scene of this end game play. And the sign is when evil reveals itself out in the open, we know that the end game is almost here. This is 1980. Remember, the gold peak is over here at the beginning of the chart. January 1980, about January 21st, 1980, it's about over here, maybe over here. Exactly where it is, I don't know, because I don't want to count these candles, but you can see the main rally, the big rally in Homestake Mining, the premier gold stock back at that time, happened starting in May of 1980 and moved from about $7 to $22, about tripled during 1980 after the gold peak had already happened. So there's another incentive to get some gold mining stocks because you don't know when exactly they're going to rally. They don't necessarily trade in line with gold and silver all the time. So it is one way to gain exposure to rising bullion prices. And the final thing I want to talk about as to a very obvious sign that the end game is almost here is that the other side is getting unmasked.
The pressure is building, and the global financial system is inching closer to a breaking point, where liquidity dries up, reserves get pushed to the edge, and key markets start to crack under the strain. When that moment comes, central banks won't sit on their hands. They'll almost certainly flood the system with fresh money through massive monetary expansion. At first, that move could shock investors and trigger a wave of selling in gold and silver as people scramble for cash. But history shows that these shakeouts rarely end the bull market. They actually set the stage for its most explosive phase. Looking forward, government borrowing is out of control, global debt keeps climbing, and the entire economy is more reliant than ever on endless injections of liquidity. When the next crisis hits, the response will likely be bigger, faster, and more aggressive than anything we've seen before. And once that initial storm passes, gold and silver could be the biggest beneficiaries as faith in paper assets collapses and hard assets reclaim their role as the ultimate store of value. If history is any guide, what starts as panic selling could turn into one of the most powerful rallies we've ever seen. Could the next liquidity crunch be the spark that sends gold and silver into a historic moonshot? Drop your thoughts in the comments. We want to hear from you. And if you found this breakdown valuable, hit that like button, subscribe, and turn on notifications so you don't miss what's coming next. Thanks for watching. We'll see you in the next video.